Hey guys, JJ here, back again with another Thursday of Zoom networking. And boy, we have a great surprise in store for you today. We have a guest speaker today, and just couldn't bring to you a more awesome, smart guy as far as real estate goes. My good friend Brian Fine. Brian, how are you?
Doing fantastic, JJ. Glad to be here.
Hey, we're gonna let's get right to it. What are you gonna be talking about today?
Today, we're going to talk about just an introduction to lending on real estate projects. We're going to just high level, what do we look for when someone comes with a funding request? So, whether you're a lender looking to deploy some capital and not want to lose some money, or if you're an investor and you want to make sure that your project looks good to the lender, it should be a pretty good call for you.
So, Brian, it's all you, brother. Take it away.
All right, awesome. So let's start with high level lending in on real estate projects. So a thing to understand about the lending side of the real estate business is that money is the second easiest product on the planet to sell. Everybody wants it. You will have no shortage of people who want your capital. That is not a challenge. Instead, we have what we call a reverse or inverse marketing problem. We need to find projects that are safe to invest in. So we need to vet both the people we're dealing with and the projects that they want us to fund. So first thing I'll give you guys, and this is, I like you guys to all just take notes. So if you grab your notebook, it is better to physically write notes than it is to type them. It is better for your brain. You'll retain information better and overall increases your retention and learning. First thing we have is what we call the cash rule. And that is ignore everything about the project except what it looks like if you 100% funded it in your own cash and only looked at it from that money's point of view. So if I'm going to do a rehab project, for example, we're going to buy the property for some amount of money. We're going to fix it for some amount of money. That's going to take some amount of time, and then we're going to get so much out. So let's say I'm going to buy it for $100,000, fix it for $50,000. That's going to take 6 months. And I'm going to sell it for, let's say, $250,000. Okay. And I don't have to think about anything else, just those high level numbers. So I'm going to buy it and fix it for 150. I'm going to turn around and sell it for 250. So in gross equity, not counting any other costs, we have 100K of equity in that deal. So not too terrible. That should work on paper. And we're going to do it in 6 months. So if I did that in my own money, somebody can whip out a calculator and tell me if I invested 150,000 for 6 months, and then afterwards I got back 250,000, what is my percentage return on that money in that 6 months?
66%?
There you go. That sounds about right. Yeah, it should be a nice high return. So here, let me do it real quick. Here's the math for anybody who's curious. So you take the smaller number and divide it by the bigger number. So I take the 150,000. I'm going to divide it by the 250,000. And then I multiply it by 100. So I'm getting a 60% return. But we said it's in 6 months. So if we usually express returns in an annual, then I'm only using half of that time. So I'd actually multiply it by 2. This is 120% return on my money. Not bad, right? I could, in theory, do this twice in 1 year. Does that seem like a decent deal from a high level to invest in? Yes or no? What do you guys think?
Yes.
Give me some reactions. Yeah, it seems safe enough. Is that actually what's going to be made? No, it'll be lower than that. But in the broader sense, we can look at it and say it's not a red flag. So it works with cash. Only if the deal works with cash could we apply financing to it and have a chance of it being okay. So let's do the same kind of math again. Let's take a look at it again. Let's buy it for 100,000 this time. Same thing. And let's fix it for 50. So we got the same $150,000 investment. But this time, we're going to sell it for $190,000. So let's go ahead and we take 150,000, we divide it by 190,000. What are you guys showing for a return?
It's almost 79%.
Yeah, but that's this time it's a lot tighter, isn't it?
Mm-hmm.
See how the math's a little screwed up? It doesn't actually look that way.
Yeah.
That only has a $40,000 margin, and that $40,000 margin won't actually be there. We'll have a 6% realtor commission. We're going to have taxes, insurance, carrying costs on utilities. So even with our own cash, that number is going to get slashed in less than half. And so that looks a lot more dangerous, doesn't it? Guys, see how this plays out? So that is the loan to value. Gives us an idea of what our return is going to be. We need to see enough of a return on that large gross cost before we'll even consider investing in the project, both as an investor and as a lender. They have to make sense. On a rehab project, we generally want to be in at less than 75% of loan to value or investment to value. As an investor, even with your costs of carrying costs, insurances, utilities, all that other stuff, and your financing, you don't want to be over 80. Because if you are, and something goes wrong in the project, you won't just make less money, you may go negative. Remember, you still need to pay back your lender. Does this idea make sense to everybody?
Yes.
Does to me.
We call this number, when not applied to lending, it's just a cash thing, is ITV, or investment to value. So as an investor, that number doesn't go over 75 for us. One thing we can't fake is equity. If that number gets over 75, it gets real dangerous real quick. We start not being okay with the amount of equity in the deal, and if anything goes wrong, we'll lose money. So that's rule one, the cash rule. It's the same idea for your rental properties. That's a cap rate. So if you guys want to write this down, I'll give you a way to cheat really, really fast. So rentals can be very easy. It's 12 months of rent. It would be the income on the asset, and that's against the purchase price. So let's say I have a property that rents for, let's do $1,200 a month. So it's not a completely round number. And I got 12 months of that. So I'm making $14,400 a year. That's great. And I divide that by the purchase price on the asset. So let's say I bought that property for $150,000, and then you multiply that number by 100, and that gives me a what? What did you guys get for your math? 14,400 divided by 150,000. What's your number?
9.6.
9.6. That's it. It's expressed in a percentage. This is a gross cap rate. Okay, then we're going to apply one more multiple. This is where you cheat. This is the difference between people who make money and people who lose money. And this is if I don't know anything else. If it is a single family house, I'm going to take that number times 0.6. So take your 9.6, multiply by 0.6. And if it's a multifamily, I'm going to multiply it by 0.45. 0.45. So let's say this one's a single. So I'm going to take my 9.6 times 0.6. What number do you have now? 5.76. So that number that we applied at the end there that lowered it, that is your expense ratio. That is all the stuff we're going to have to pay that isn't a mortgage payment. That's taxes, insurances, reserves for maintenance, reserves for vacancy, property management. All that stuff's got to go in there and kick out. On a typical single family house, that's going to come up at 45 to 50%. So we have that guy at the moment at 45. Or 40. We just did 40. On a multifamily, that ratio is higher because you have to also pay common area charges and landscaping. So those run 50 to 60%. So that's why we use the higher number for that. The number you're left with, in this case, 5.76, is the effective cap rate of that investment. If I reach into my pocket, spend $150,000 on this property, then I will expect to net somewhere around 5.76% of that $150,000 per year. Does that make sense to everybody? Everybody get that? So it's that 5.76 is what we call the net cap rate, or you could also call it net operating income if you want. That's usually the term we use post underwriting, but you can do that here too. That is the return that you will get. So if I reach into my pocket, I spend $150,000 to buy this rental property that rents for $1,200 a month. I'm going to get that $1,200 a month. I'm going to have a bunch of reserves and expenses and other stuff I have to deal with. And at the end of the day, I'm going to get 5.76% of my $150,000 back per year in cash flow. That's what that looks like. Everybody understand?
Yep.
Yes, sir.
Okay.
Yes.
If that looks okay to you, then you can proceed to say, can I get a mortgage for this? If that seems like a terrible return, then this is not a deal for you at this number. You would either need to buy it cheaper or just simply go find something else. This is the thing that when people bring us a funding request that we are not going to move forward with, this is the most common test that fails. The numbers simply do not make sense. They want to pay too much for it. They forget a bunch of expenses. You want to use that gross number. You want to use that 9 number instead of the 5 number. Well, those expenses are there whether you want them to be or not. You're going to have to pay them. All right. What percentage range is bad for net cap rate? That is up to the investor. I can tell you that what I look for in single family investments is somewhere between a 6 and an 8, which means that even the math we just did is a bit low for my own personal investment. For a multifamily, it's going to be about 1 to 2% lower than that. So you're at a 5 to 7 at best. Okay. If you see them less than that, then they're going to make very little money. That doesn't mean they're not a deal. We all have our own profiles for this. I'll give you an example. A reason to buy rental property, a really good reason to buy rental property, is so that you can lose money. And I don't mean that sarcastically. You want to lose money for taxes. We want to get that depreciation loss. So if you're buying for that purpose, the cap rate is far less relevant to you. You just don't want it to be cash flow negative. So you can live with a much, much lower cap if the tax benefits make sense. So there are different profiles for that. One thing I will warn you guys about, something that we call the greed factor. The higher numbers, 5, 10, 10, 12 net caps, things like that, those are not offered by markets that typically would be comfortable investing in. That's just not what the market gives you. So if you're looking at something like that, we would consider it a red flag. That usually means the location is extremely poor or the property is in very bad condition. There is a chance that both of those things are false and you do have a real deal at a much, much higher cap than is normally offered in the area. But just so you know, we look at that very carefully. There is typically a reason that you're getting something that weird or out of scope. Okay, make sense? Everybody get that? That's the cash rule of investing.
Yes.
Make it make sense with no financing. Just pretend you're reaching in your pocket. Now, investors, warning for you guys, when we're looking at these kind of investments, just because the number comes up positive does not mean it's a deal. We're going to look at, in addition, exposure. The examples I just gave are at $150,000 investment, which is relatively small for most real estate deals. If I was looking at that same return for 5-10 million, the amount of exposure on that would be ludicrous. I would not even consider such a thing. We're going to want to see a better return for our money. Remember that what is often considered the safest investment readily available in the world is the 10-year treasury bond, which rides somewhere around 4% is about where it's at. So when your deal, which has a lot more risk than that, is not coming up quite a bit better, you're not competitive. The deal won't make a lot of sense as a cash deal. And if it doesn't make sense as a cash deal, the amount of leverage you're going to be able to put on it, the amount you should be asking from a lender is going to be quite low. So you're still going to end up bringing a lot of equity to the table. At the end of the day, if it was paid for in 100% cash, it has to make sense before we apply lending. Does everybody get that concept? Make good sense?
Yes.
Yes.
Okay. So when I was listening to you guys, a couple of you were talking about your having different projects that you're you're looking to put together or get funded or everything, put it through this lens. You want to fund a piece of ground up construction. Great. Do you already own the land? Because that's pretty much step one. You have to buy it. And then if we buy it, build it, and sell it, there's a timeline. How long is this going to take? Plus permitting and that kind of thing. I think I talked about that last time, didn't I, JJ? I talked about the timelines and hidden costs.
Correct. Yes, you did.
Yeah, so this stuff can take a while, and a ground up construction project is a really big construction project. So depending on where you're at, you have your permitting, you have your timeline, you have all the delays that come with that. So now, we're going to buy it, we're going to expose all this cash to build it, we're going to do all the labor to manage it, and then we're going to sell it on the other end for hopefully equal or more than we initially anticipated. If we're going to take all that risk, does the return make sense? If you just reached into your pocket and spent your life savings to do it, does that make sense? I can give you guys an example. My market of Pittsburgh, there's only a few zip codes we can make new construction pencil for us. It's not that we can't do it. I can totally build anything I want anywhere I want. But here's my fundamental challenge. I can buy a distressed property all over Pittsburgh, and I can rehab that thing for about $80 a square foot if it's a really heavy renovation. New construction runs more than $200 a square foot. So if I'm going to make that much larger investment, I would need to see a much larger return for it to even make sense in my market. And most of the time, in my case, those deals don't pencil. Now, there's lots of places they do. Florida, Texas, California, new construction can work phenomenal. But in my backyard, it's a lot harder to make it make sense, even if the deal makes money. So consideration 2, after cash, is your market. What makes sense for that market you're in? What kind of return are you getting for that deal? Does that make sense to everybody, or did I just say that all confusing?
I
Yes.
think it made perfect sense.
Okay.
That makes sense.
Generally, more affluent, higher dollar areas have lower returns in percentage. In absolute dollars, they may be higher, but in percentage, they're quite low. And then the reverse is also true. As you go to lower income type zip codes, we can typically see higher returns dollar per dollar. And so you can look at that very much as a risk reward thing. Your higher level areas are lower risk, lower reward. Your lower income areas are higher risk, higher reward. You guys have to decide for yourselves, both as investors and as lenders, where are you comfortable playing? If you want to be able to charge, I know a lot of you guys are gators on here. If you want to start charging 20, 24% interest, you can do that. But to make that make sense, to have it to be competitive in that kind of rate and that kind of charge, you're lending on extremely high risk projects. You're not going to ask a lot of questions. You are being paid to not ask questions. On the other hand, your competition in the lending space, the largest lenders are banks. They're also the cheapest money. If you find yourself cheaper than a bank, you're a moron. We should be a lot more expensive than a bank. Don't do that. If you guys, as private lenders, find yourselves cheaper than me, you're probably doing it wrong. This is not a race to who can charge the least on a project. That is not how we're playing. This is math based on the risk profile. So if you want extremely high returns, then you're going to be taking a risk. If you want to be super conservative and never lose no matter what and still lend in this vehicle, then you're a bank. You can ask all the questions. You can do all the kind of underwriting. You can vet them as hard as a bank. But if you want a lender or a investor to take you seriously and put up with that much nonsense, your pricing better look a hell of a lot like the FHA headline number. So if you're cool lending at 80% or so max of their project and asking them every question under the sun, and they're okay borrowing at that, then you should be charging them probably somewhere in the 7 or 8% range. If you're okay doing that, Go with God. That's awesome. But that's how that balances out. Don't be the person who's asking a billion questions and trying to charge 20%. You'll find it doesn't work very well. Does that make sense to everybody? Okay. Investors, when you are packaging your deals, make sure that they check these boxes. Make sure that that deal makes sense as a cash purchase and has enough equity in it that you can afford to pay a competitive interest rate. And honestly, investors, you shouldn't care what the interest rate is. It's just a cost of money. You should have enough margin in your deals that it works. Does everybody get that? Is this a different way of thinking about the transaction than you've had before?
Yes.
Most of the time when I disqualify a deal, it fails this litmus test. We never even get past this. They bring me a deal that makes 0 sense. All right, things that increase risk profiles. I see these a lot. Weird shit. Let me define weird for you. Rural. Strike one. Not a single family or multifamily residential asset. Strike two. This is all your RV parks, small, tiny home communities, blah, blah, blah. It's not a single family. It's not a multifamily. It just got weird. And strike three, and this one is happening pretty much nationwide. This is why you, if you're a lender, you really want to work with people that are very close to the industry and know stuff. Is market specific, and is that market appreciating or depreciating, and what is the default rate across similar mortgages in the market? You guys are not going to know this information unless you're involved heavily in this industry. I'll give you a really simple example. A deal that we're looking at in Daytona Beach, Florida. This is a several hundred unit multifamily. One of the things that came up almost immediately is that Daytona Beach over the last 12 months has depreciated in value 7%. You wouldn't see this or know this unless you're very involved. You wouldn't necessarily know that the state of Florida has seen a slight uptick, 1%, in private mortgage defaults. That's 2 strikes. That's 2 massive things that I need to know. If I try to underwrite that like every other multifamily deal out there, am I at much greater risk? Is my investor at greater risk of being screwed and losing money? Worst possible outcome for a lender is that we have to take back the property. I don't want your property, I promise. I would just buy it myself if I wanted it. And at the time I have to take it back, the investor is wiped out. You're already done. You burned to the ground. So we want to make sure that there's enough room that everybody's making money. So you need to take into account the market considerations. For most of you guys, you private guys, you gators out there, I would strongly suggest you do not lend nationally to start with. That is a much more advanced place to be. Pick a state you're comfortable in, lend there. Does not have to be the state you are a resident of, mind you, but pick one. That's also where all of your foreclosure laws are going to come from, and it's going to determine your risk profile for the state. A simple example for you guys, which state do you think will be easier to foreclose and take back a property in? The state of Texas or the state of California? It's not even a question, right? It will be far more difficult. There's going to be a lot more lawyers involved and nonsense to get my property back in California than in Texas. So you just want to know up front, where are you choosing to do it? Okay. We are a national lender, or about as close to it as you can get. There are certain states that nobody does private lending in, but we'll lend in most of those states. Some of them can be a real challenge, and we need very specific attorneys to deal with it, and it changes the kind of terms we could offer. So the market and the state laws can also very much affect the way we do things. We look at the economies in those states and those cities. I want to know, are they going up, are they going down, or defaults higher? You guys can write this down. It may change in a month or two. But New York City, Philadelphia, Baltimore, I'm out. I won't even quote a loan in those places. The default rate has gone through the roof, and so has fraud. They are extremely high risk markets for lenders right now. That stuff changes all the time. They could go back on the table as things balance out. It could get worse and spread to more cities. But these are considerations that we have for every transaction. That's data from across the entire private lending industry. So the private lending industry is about $55 billion a year. About 40 billion of that is concentrated in 10 companies. We are very good friends with the CEOs of all of them, and they all share data. The other 15 billion is made up of little tiny guys like us. We're the rest. We're the tiny minority there. But we get all the same data. We learn everything they learned. I know how that 40 billion in lending behaves. I know who's defaulting on loans and who isn't. And we know very soon if somebody defaults on a loan anywhere in the private lending space, that will go on to a list that is shared among all lenders. So one default will blacklist you across every lender. That will probably be a thing within 12 months. Very, very soon. Okay. So let's do a quick recap, and then how about some Q&A on this stuff. Rule 1, it has to make sense as cash. So first thing, pretend you're reaching in, pretend it's all your money. I have whatever the investment is the total amount of cash I have. It's my life savings. I'm going to invest it in this. It's going to stay for X amount of time, and it's going to come back with so much friends. Does that math make sense? If yes, cool. Then we can start talking about what kind of financing we could use on that project. If no, run, don't walk. It's not a deal. Item 2, is it weird? And compounding weird is even worse, right? So I gave you guys a couple of weird items. But if I have a rural tiny home community that's doing short-term rentals, that's 3 really weird things. That's not a thing that comps. It would be a very, very high risk investment from the point of view of a lender, because if we ever had to take that asset back, liquidating it and getting our money back out will be very challenging. So as an investor, you need to look at it the same way. It's hard to sell. It's a weird, niche-y thing. Not saying it doesn't make money, just saying it's a higher risk profile. Okay, so is there weird stuff? And then your market considerations. What state am I in? What city am I in? What good or bad things are going on there? Is that market going up or going down? So I gave you guys the example of Daytona Beach going down 7%. In order to account for that, when we do the appraisal on the asset, I immediately will take 10% off of the future appraised value for my calculation, which means I'm going to invest a lot less as a lender in that project. 10% off your LTV instantly. Because if I do less, I might get burned next year. Questions?
Yeah, Brian, on the expense ratio, was it multifamily was 0.6 or 0.45?
It's expenses on a multifamily are going to run you 50 to 60%. So you're at 0.5 or 0.6. Or well, when you do the math, remember it's the reverse. So it's 0.4 if you're doing 60. Yeah, for those of you who came to our live event, we gave everybody a booklet. I had a cheat sheet where we actually broke down a lot of those variables for you. So you just have them there, but put them in your notes and know that stuff up front. A big thing with rental property, it's ultimately an expense business. You got to manage your expenses. And a thing to keep in mind is that expenses have gone up quite a bit in the last 5 years. And so a lot of the information you're getting, I don't care what your education program is, unless it's somebody who is running a large active rental portfolio today with data for the last 5 years, they're probably quoting you much lower numbers. When I started building our current rental portfolio in 2019, 2020, on a single family, we're using a 30 to 33% expense ratio. Today, it's 45 to 50. Like it's just simply higher. That's increases in insurance, utilities, cost of maintenance, cost of vacancy. It's just higher across the board. It's inflation. That's what that is. And multifamilies have always been worse and will always be worse because you have to pay those common areas and your landscaping and that kind of stuff. So you're always going to be higher on those. Multifamily starts at 50 and can go up from there. So I would underwrite most of those preliminary at 55 to 60. If somebody is showing you a pro forma as a lender, if they're showing you expenses that are lower than that, don't go with those numbers. Use the ratio I just gave you. If they show you expenses that are higher, that's fine. Use their higher number. Don't go lower, though. You'll be sad.
Felicia, you're on. Brian, what's up?
Hi, Brian, I have a question about LLCs. If I'm lending outside of the state that my LLC is in, do I need to have an LLC in that state?
No, but
Okay.
depending on the state, you may need to have a mortgage license.
Okay. Thank you. Good to know.
Yep.
So, Brian, obviously the LLC laws vary per state, correct? Are they great differences or?
LLCs are pretty well. It's about the same. How they're taxed is by state, but the way they work is pretty consistent across all 50. So LLCs are fine. It's the big thing that comes up for you guys as lenders is again, I'll use California as an example. You need to have a California mortgage broker license to be able to lend in California, and the legalities of getting it are a complete pain in the ass. So those things do happen and they do come up. Now, I will tell you, you will probably get away with not doing it. But if you do it at any scale and the state of California comes after it, don't come crying to me.
Okay. Let's see. I'm looking in the chat to see if there's any questions we have there that we missed. Okay, we had something here from Sean. Sean, are you there? Are you still there?
Yeah. I think what I was trying to input is that PACE does an accelerated depreciation
Mm-hmm.
for resident property, and I believe 7 years is the max. Then it creates an LLC per transaction for not only the tax depreciation purposes, but also for liability. Is that something?
That's
Because I'm fairly new to the taxes.
That's not quite how it works.
Oh, okay.
The accelerated depreciation is more accurately called cost segregation. You pay a third-party accounting and engineering firm to come in and produce a report for your property. That report can then be given to the IRS, and effectively, the exact mechanics are a little different. Effectively, it changes the depreciation schedule on the asset. So on a single-family house, a depreciation schedule is 27 and a half years. On commercial, it's 40. So that report will effectively condense it. Instead of saying the whole house will fall over and depreciate in 27 and a half years, they'll say the floors have 5 years left, the windows have 8, the roof's got a decade. And they'll break it all down that way. And so what you effectively get is the ability to depreciate more faster. There are also some first-year depreciation options, first tax year to be clear, depreciation options that came in the recent legislation, that big beautiful bill. You can look at where we're able to depreciate certain things fully in year one. Now, the side effect of that is when you depreciate things, you're lowering what's called the cost basis. So if I spend $100,000 on a property and 20 years from now I sell it for $200,000, the way the IRS would look at that is I spent $100,000, so I made $100K in profits. They're going to want a capital gain on that $100K. When I depreciate and I take that money out as a tax loss, they lower that initial $100,000. When I finish my depreciation, I made it zero. So now when I sell my property for $200,000, it's $200,000 of capital gains. That's what depreciation really means. Now I can not pay that by either A, not selling it, or B, doing a 1031 exchange into a different asset. So those things all work. There is one more trick that is really, really powerful, and that's called an opportunity zone. You guys heard of these things?
No.
So opportunity zone, they tend to be these lower end areas, C minus type areas. The benefits they give you, there's a whole bunch of them, but the one that I care about the most is if you hold a property in an opportunity zone for 7 years or longer, you can, in most cases, this does vary a little, so consult your appropriate professional, you can pay no capital gains on that asset, which means if we buy a multifamily property or a bunch of singles in an opportunity zone, hold them for 7 years, do cost segregation, depreciate them completely. So if I spend $1 million on a building, depreciate it completely within, let's say, 7 years, and then sell it for $2 million, my capital gain on that will be zero. And so I get to keep all that. So it can be very, very attractive from a tax point of view. And the government is doing that in order to attract your money into those areas they want to see developed. So it's usually an affordable housing attached type idea. So it can be real sexy from that point of view. It can be a very, very cool benefit, but please consult your appropriate accountant, tax professional, so on and so forth. Okay, so that's your opportunity zones, and that's cost segregation. But it doesn't. It's not a magic button. You do not get to pick how accelerated the depreciation is. That's a function of the report that is generated by the whatever company you pay to do it. And if you do accelerated depreciation cost segregation, then you should be planning on either never selling the property ever or doing a 1031 exchange, because otherwise you'll be paying it all back in capital gains.
Anyhow, Brian, I want to ask a couple last things before we kind of cut loose. We've hit the 90 minutes as we do. If people want to get a hold of you, they've got more questions, they want to ask you a couple things. What's the best way for people to reach you?
To reach me directly, you can just use the phone number I have on the screen there. It's 412-212-6627. Send me a text. I'm on the phone all day. If you cold call me, you're probably not getting through. But yeah, happy to talk to everybody. And then for those of you who are want to get into this lending game, you want to learn this stuff in a lot more detail than I briefly went over tonight, I suggest you speak to JJ directly and have an interview about joining our equity lending done safely group. I will probably once JJ tells me he's got a good group of people ready to go in there, I'll probably run the first round of education in that in the next few weeks. We'll get that done. We've been meaning to do it. We keep getting distracted. I have a lot of loans to underwrite, but we'll take you guys through an initial run of that. We'll show you the business model, not just lending, but we'll show you actually how to invest as an equity partner, which is a very, very lucrative way to do it if you learn the underwriting correctly, if you can make it make sense. So we'll take you through all those different things and how that works in extreme detail.
Cool. All right, guys. Hey, y'all, thank you for joining us today. Stick around. Don't go away. We're going to continue talking rap a little bit more. And if you guys are on YouTube watching us, please like this video, like Brian's video. Please put your comments in the chat. Want to connect with me? You can register for the group by clicking the turquoise QR code. Want to subscribe to our YouTube channel? Click the purple QR code, subscribe. Look for more that's coming up on Flipside Up on the YouTube channel, and join our group and jump on our Zoom calls. Everybody else on the call, stick around. Brian, we'll see the YouTube crowd later on, right? On social.
Yep. See you guys on the next one.
Thanks, guys. Over and out.